Hello, my name is Jim Toot, and I'm an Associate Professor of Political Science at Central Virginia Community College. In this video, we're going to be discussing the Great Recession of 2007 and 2008.
The U.S. economic system is capitalism. It encourages individual enterprise, a free market, and relatively low taxation. It discourages government intervention and regulation of the economy. Capitalism can produce both vast wealth and vast economic inequality. The top 300,000 earners pocket almost as much income as the bottom 150 million. This inequality has been increasing in recent years. From 1980 to 2001, the income of the top 5% of Americans went up 11 to 20 times the income of the poorest fifth. Economic inequality is related to social inequality. Women and men now attain similar levels of education. On average, however, working men earn 78 cents to every dollar earned by working men. Professions most populated by women usually pay less than professions most populated by men. For instance, in medicine, nurses, mostly women, are paid less than physicians, mostly men. Female university professors are generally paid less than male university professors, even at the same rank and with similar years of services, particularly in private colleges. Income differ dramatically by race and ethnicity. The household income of whites, Asian Americans, and Pacific Islanders averages well above $50,000. For African Americans and Latinos, it's under $32,000. African American families and Latino families are 3 times more likely to live in poverty than white families, although this gap, particularly between black and white individuals, has shrunk over time. In 2007, the economy was humming along, with the stock market soaring, employment high, and inflation, increases in the cost of living, low. Public policies encouraged the dream of homeownership by enabling people to deduct on their tax returns the interest they paid on their mortgage loan, and by a Clinton-era law excluding from tax all or most of the profit they made from selling their homes. But these policies did little for people unable to obtain mortgages because of low income and poor credit records. So President George W. Bush, promoting an ownership society, pushed policies to enable the disadvantaged and those with poor credit, especially minorities, to buy homes. This vastly increased the number of subprime mortgages, home loans made to people usually unqualified to receive them. Lenders peddled easy credit, asked for low and no down payments, and did not require incomes to be documented. Some borrowers were given adjustable mortgages with low interest initial teaser rates, which would later rise much higher, and charged big fees hidden in the interest rates. The Federal National Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Association, Freddie Mac, were shareholder-owned and profit-driven corporations sponsored by the government to buy mortgages from the banks, thereby freeing up cash for new mortgages. They financed most of the home loans made in America. They plunged deeply into the market for subprime mortgages, relaxing credit requirements on the loans they bought from lenders. They also spent heavily on lobbying so that Congress did not raise their capital requirements. Propelling the subprime mortgage market was the tremendous growth in complicated and opaque securities. Lenders sold the original mortgages to Wall Street and then used the cash to make still more loans. The investment and commercial banks sold packages of mortgages as mortgage-backed securities, or MBS. These were then combined with other securities, for example, commercial mortgages, credit card debt, and student loans, and sold as collateral debt obligations. These arcane securities were rated as very safe by the rating agencies, but these raters had an obvious conflict of interest. They were paid by the institutions whose securities they rated, rather like a movie producer paying a reviewer to write a favorable review about his movies. Gripped by a fervor for deregulation, the government had reduced its oversight of the financial system. In 1999, Congress enacted and President Clinton signed legislation enabling commercial banks, which collect deposits and loan money, to deal in securities and thereby engage in speculative investments. The government also abolished many restrictions on affiliations between banks, investment companies, and insurance companies. As long as home prices went up, the value of homes increased, and interest rates remained low, homeowners could continue to pay their mortgages or sell at a profit. Flipping or buying and selling property repeatedly to make money became common. Disaster loomed beneath this glittering surface. The Federal Reserve Board raised interest rates, thus increasing monthly payments for many people with adjustable rate mortgages. Some of them defaulted on their loans, losing their homes. Housing prices fell by around 25% in many major markets. Lenders or mortgage holders repossessed property, reselling it for less than the amount owned on the mortgages, and thus taking a loss. There were so many failed mortgages that the sellers of credit default swaps did not have enough money to pay the claims. Starting in June 2007, but only fully acknowledged in the fall of 2008, the financial system failed. Investment firms and banks declared bankruptcy or were taken over at fire sale prices. The stock market collapsed. People's retirement accounts and the endowments of universities and colleges dropped precipitously. Fannie Mae and Freddie Mac, which had taken on debt to finance their purchases of mortgage, experienced huge losses on the defaults and were on the verge of insolvency. There was a liquidity crisis. The credit market froze, making credit unavailable. Banks hoarded their capital and refused to lend. They assumed that other financial institutions were in financial trouble and would not be able to repay them. State and local governments, businesses, and families had difficulty borrowing and thus spending. There was a drastic fall in demand for construction, investment, goods, and services. Millions of Americans lost their jobs and thus their employer provided health insurance. The crisis affected not only those with subprime mortgages, but also those with regular mortgages. Both groups often faced foreclosure on their homes. Nearly a quarter of all homes with mortgages became worth less than the money owed. These homeowners were thereby encouraged to default on their loans. Government at all levels faced massive budget deficits as their income from taxes decreased and their expenditures to pay for the safety net of unemployment compensation and welfare increased. So how did the government respond in terms of policy? The federal government's involvement in the economy, once controversial, is now tolerated if not expected. It was spurred by the Great Depression of the late 1920s and 1930s, in which the unemployment rate reached 25%. The task of policymakers faced with the new crisis was to rescue the economy and to try to prevent the meltdown from happening again. Policymakers' responses initially lagged behind the crisis and were improvised and contradictory. The Bush administration requested $700 billion to buy up toxic mortgage securities, but then used the funds to purchase stocks in banks. The responses became more focused. The Federal Reserve Board slashed interest rates to lower borrowing costs, bolster the real estate market, and encourage spending. Intervening in Wall Street in unprecedented ways, it committed trillions of dollars to rescue or bail out the financial system and prevent the failure of major financial institutions. It gave them loans, guaranteed their liabilities, and brokered deals, for example, takeovers or sales of one financial institution to another. It carried out these actions on the grounds that an economic collapse would cost millions of jobs. Treasury Secretary Timothy Geithner devised a public-private investment program to buy up and hold as much as $1 trillion in toxic assets. The Treasury and Federal Reserve Board carried out stress tests to determine whether individual banks had resources to survive a recession. The government took over Fannie Mae and Freddie Mac. It extended as much as $400 billion in credit to them and spurred them to refinance millions of homeowners at risk of losing homes. It left their future and the fate to be decided later. The government also funneled $185 billion into AIG to keep it in business. The government sought to create 2.5 million new jobs, or at least protect existing jobs, with a stimulus recovery plan of $787 billion. It invested in infrastructure, roads, bridges, and alternative sources of energy. It sent billions to the states for public schools, higher education, and child care centers. These programs would take time to be effective, so for immediate relief, the administration provided funds for some people unable to pay their mortgage and sent the states additional monies for the safety net, unemployment insurance, and other benefits. On July 21, 2010, the President signed legislation imposing new regulations on the financial industry. The law was the result of detailed negotiations, compromise, and intense lobbying. It established a council consisting of government officials led by the Treasury Secretary to track risks to the financial system. It set up a Bureau of Consumer Financial Protection inside the Federal Reserve Board, and it empowered the board to liquidate failing large banks. It authorized the Security and Exchange Commission to oversee private equity and hedge funds with assets of more than $150 million. It regulated some of the riskiest business practices and exotic investments, including credit derivatives. It curbed commercial banks' ability to make speculative investments for themselves, proprietary trading, although they could still make them for their clients. The government's response to the 2007-2008 economic crisis was unusual. In the next video, we'll turn to the government's usual economic policies and the institutions, most of which we have already mentioned, responsible for deciding and implementing the policies.